Stock prices go up and down, the Federal Reserve tightens or loosens, and CNBC can bring on dozens of finance celebrities, but overall, nobody really cares about financial markets. There's really only one price Americans obsess over daily: the price of gasoline, the miracle liquid that powers the Western world. If you look at Earth from afar, all roads lead back to this precious fluid, one whose price is advertised on nearly every major intersection in America. And it's no surprise when you consider just how much gasoline we consume. The average American uses up 570 gallons per year, which at current national average prices would cost close to $2,000 annually. We know that gas prices have always fluctuated, and for the past decade we have enjoyed mostly low costs given the situation in the energy markets. Today, however, that situation is changing rapidly. As of February 6, the average price per gallon here in the United States is $3.43. In today's video, we talk about the potential gas shock that may be coming and how it will affect the economy. We start with some basics. We know from various sources that the price of gasoline comes down to 4 factors: taxes, distribution, the cost of refining, and crude oil prices. The last item there accounts for 70% of the price, so we can summarize and say that the price of crude oil largely determines the price you pay at the pump. Now, outside the financial YouTube bubble, there isn't a lot of attention being given to the rapidly deteriorating situation in the crude oil markets. Not many who watch this channel can remember the days of 2008, when most Americans were paying well over $4 a gallon to fill up. The current oil shock could be a lot worse, and in today's video we break down the catalysts that can drive up the price to insane levels. The first part of this problem is simple: supply and demand. According to various sources, oil demand has already surpassed pre-2020 levels, showcasing that demand is back and better than ever. Supply, on the other hand, has not kept up. There are plenty of reasons why, but one quick look at inventories and you'll see that there is a potential for a severe shortage, especially as we approach the spring and summer, which should in theory break every demand record ever. If you don't believe me, then you should believe Rob Thummel, a senior portfolio manager who sat down with CNBC to explain. Take a listen.
It's interesting, we've actually asked a lot of energy followers who don't want $100 a barrel oil. The investors don't really want it, the companies don't really want it. Is it going to happen anyway?
Yeah, well, so right now, I think, the setup for $100 oil is possible. If you think about what's happening, we've really got global oil demand that's approaching or reaching where we were pre-2019, pre-COVID. But yet supply has not kept up. OPEC is not keeping up. The U.S. is not keeping up. So as a result of that, we've got a big mismatch between supply and demand. You've got inventories falling, and frankly, we've got oil demand that's going to increase into the summer, which really is a setup for potentially higher oil prices from here.
Okay, so oil is likely headed up, but how bad can this really get? Well, to answer that question, we can take a peek at the previous oil shock, 2008. Back then, prices at one point hit $147 per barrel, which adjusted for inflation would be $185. At the time, gasoline prices hit a record high as well when the US national average reached $4.11. That number adjusted for inflation would be $5.32. So that gives us some perspective, but in reality, it could get a lot worse. You see, last time prices reached these levels, we saw something that analysts call demand destruction. That's just a really fancy way of saying that prices got so high, people began to cut down on gasoline use. They avoided the road trip vacation, they began to carpool or use public transportation. It simply got unaffordable to drive. Today, however, we are not seeing this, and the level at which demand destruction begins is likely far higher than what it was in 2008. Oil companies and even nation states are well aware of this fact, and many experts claim that organizations like OPEC would thrive and print money in this price environment where we could potentially see the first $200 barrel in history. Even OPEC's very own reports citing oil surplus levels have been revised down multiple times over the past few months. The springtime is now looking like the grand reopening everyone was hoping for last year, and with the potential of a massive spike in demand and speculators now hopping on the price momentum, the possibility for wild swings has grown exponentially. But much of the movement we are seeing these days is, according to many experts, being influenced by the rising tensions on the border between Russia and Ukraine. Putin has amassed over 100,000 soldiers in the area, and many believe he's going to overrun his neighbors. As the world's third largest crude oil producer, Russia holds a massive stake in influencing prices around the world. An invasion would put a big question mark on these Russian exports, given the inevitable sanctions that would come with an act of war. At the same time, diplomatic efforts may work and the situation could cool down. No one summarized it better than Helmina Croft, head of global commodity strategy at RBC Capital Markets. She was on CNBC this morning to explain, but before I show you Halima, please take a moment to hit that subscribe button if you're enjoying the content. Now back to the video. Let's take a listen.
We keep saying, I feel like almost a broken record every morning, that oil prices closed at their highest level since 2014, every day setting a new level. Has all of this been baked in, or do you think there's a lot more room to run higher if any of this actually breaks out?
I mean, Becky, if those Russian troops cross the border, I mean, that is your clear path to 100. There'll be a lot of concerns about disruption of Russian energy supplies. I mean, again, they are the commodity superstores. There'll be concerns about disruption to gas flows to Europe, to oil exports globally. What are they going to do with wheat, with palladium, with coal? So there are all these questions about what will happen to Russian exports in the event of an invasion. On the other side, though, if you have those Russian troops pull back, if you get some type of diplomatic settlement, if you get a breakthrough in the Iran talks and potentially 1 million extra Iranian barrels hitting the market, that could cool off the rally. But again, I think all focus is going to be on what happens with Russia-Ukraine this week.
So there you have Helena essentially saying that the geopolitical situation will likely be the largest influencer of prices in the coming months. No one can guess what would happen to the energy markets if Russia were to invade, but many assume it would wreak havoc on the already elevated prices. On top of this, we have multiple meetings happening this week, including Iran talks that, if successful, could easily take some price pressure off. But given the sensitive nature of the situation, it's very easily within the realm of possibility that we see massive escalations. Europeans already pay close to $10 per gallon. For example, the average price in Sweden is around 1786 Swedish krona, which converted to US dollars and gallons turns out to be $7.31. It's very possible that this could become the new normal here in the United States as well. Let me know what you think in the comments below, and make sure you hit that like and subscribe button if you enjoyed the content. Finally, if you have some time, please also follow me on Twitter. You can find the link in the description below.